Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 78 unit building, 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below. Always consult with a tax advisor, financial planner, and/or attorney before making investment decisions. Having said all that, all you need to do to learn more is go to homeinvest.com or click in the description below.
Welcome back to Purpose-Driven Passive Profits. If you have ever looked at a syndication deal that was a development deal and you see like a 3, 4, 5x multiple return or some crazy IRR return and you're like, it's too good to be true, we're here to talk to you about why that is probably one of the investments you should pass on, especially development deals right now where we're at in the economy. Welcome to Purpose-Driven Passive Profits. His name is Nate Armstrong. He's the CEO and founder. He's done more than 1,500 real estate deals. He's been an investor for more than 20 years. My name is Steve Warner. I am the Chief Investment Officer here at Home Invest, and this is Purpose-Driven Passive Profits, where we believe in being great stewards of what God has given us, sharing that with you guys and helping you find great investments, whether it's with us or with other people. So Nate, we're going to jump right into the development questions. So many people have seen this, syndicators, people out there doing fundraising, bringing in investment capital for a development project. Why do you think they should not do development? Why do you think development's risky, especially right now?
Yeah, number one, and this is a question, it's for everyone to answer. Do you think that there will be more banks that collapse? Do you think that there will be more liquidity that dries up? That's when banks don't want to lend money because they're scared about what's going on in the economy. Do you think that there's a chance that someone doing a development project who's counting on tranches of financing, that's typically how development works. The bank gives you some money to close on the land, they give you some money to start the construction, and then you have to keep going back to the bank to ask for more money. Even on approved projects, you have to keep going back and asking for more money based on the percentage of completion. Do you think that there will be banks that call in lines of credit or reduce lines of credit? Do you think that there will be banks that decide they're not going to continue to fund the tranches of development projects? If you've answered yes to any of those questions, you're probably right. If you look historically back from 2007 to 2012, a lot of development projects went belly up because the financing that once was approved became not approved in the middle of the project. Banks had no choice. Banks were collapsing, just like we've seen recently. And it's my prediction that we just kind of saw the start of the banks collapsing, and there will be more. Whenever you raise interest rates as aggressively as you just did, and then you start to see the ramifications kind of play out, you're going to see the early ones that were the most over leveraged. They didn't have deposits on hand. Those are the ones that went first. And then as we get deeper in the recession, now we're going to start to see more. So how and why does this all relate to a development project? I had somebody bring me a development project that they boasted somewhere around 35% return, and they had huge numbers on equity multiples and preferred return and all this kind of stuff. And he kept asking me, you wanted to do around $250,000 investment. And he kept saying, Nate, I think I'm going to do this one. What do you think? What do you think? He's like, just give me an honest answer. And I gave him an honest answer. I said, I wouldn't touch it with a 10-foot pole because of the questions that I just posed for the group here. Could the bank possibly not finance the project? Let's just say that even if the bank financed the project, the other problem with development right now is that you're building something that's new. You don't really know what the market is going to absorb it at. You don't know what the market's going to pay to rent whatever that thing is that you built. What if you're building a grocery store distribution center? I mean, literally, we're seeing even grocery stores, staple providers like Costco, Kroger's, we're seeing them have layoffs right now. We're seeing them get killed by inflation and not being able to keep up with margins, losing money. And so if you're building something like that and you're expecting the market to simply step in and pay what you thought they were going to pay, you might be in for a rude awakening. So if you can survive the whole bank liquidity crisis and banks not financing it, then round two of survival is making sure that you can actually achieve the rent that you thought you were going to achieve. That's why I won't touch development heading into what we're heading into right now.
Awesome. Is there a time when you would look at development?
Yeah, I'll tell you, 3 years into the thick of this, once we get really deep inside the storm and we know where the middle of the storm is, that's the time. Because the same people that are jumping in with high hopes and expectations of making a grocery store distribution center work today, they're paying a premium. They're paying the bloated numbers, everything based on hype. And then in the middle of it, when the bank starts to foreclose on them because there's no more money flowing in for it, that's when you can work with the bank and maybe negotiate a short sale. Or if the bank takes it through full foreclosure, then you can buy it from the bank directly out of foreclosure for pennies on the dollar, literally.
Okay, that makes a lot of sense. Honestly, that's kind of what we're doing right now in multifamily. So if we switch gears a little bit, if you shouldn't be doing development right now, what should you be looking at instead?
Yeah, the only recession resistant asset class that there was during the last downturn, and it's multifamily real estate. People need a place to live in the middle of a recession. When they lose their job and they can't afford to pay for the mortgage on their single family home, they're going to go to an apartment building. If they don't move in with mom and dad, then they're going to go to an apartment building. So multifamily weathered the storm really, really well during the last recession. So I'm all in for multifamily, 100%.
Well, it's not just any multifamily either. You see that guy that you were talking about that lives in Miami that is a huge syndicator, right? He's a luxury apartment guy. He's going after like the really high-end luxury apartments. That's not where you want to be during a recession. You also don't want to be at the very bottom end. You don't want to be in Section 8 or in any of the stuff that's a little bit rougher. Instead, you want to be right in the middle. You want to be good, solid, like C-class, B-class apartments that hold their value. Nate, just really quick, how do we make money in that during a recession? I know a lot of people are like, yeah, but that seems so boring. Is there any return there? Let's talk about that really quickly, because this is actually when a recession is going on, this is where you want your money. Can you tell us why?
Yeah, I love when people call what we're doing boring. And it's my favorite because boring is what you want. You don't want the crazy, unpredictable thing. We're not trying to invest in a unicorn tech company that's going to go public someday. No. We're trying to earn a nice rate of return, 16% IRR up to, and we're trying to basically do a 1.8 equity multiple. We're trying to pretty much almost double our money in a short period of time. But by short, I mean like 3 to 5 years. And that's a nice return. That's a really good thing, but we're not trying to bet on the moonshot. And so when people call this asset class boring, a multifamily property that we're simply going to go in, we're going to find an owner who hasn't lifted the rents in a while, and we're going to bring that building up to market rent, I'll take boring all day long. Who won the race, Steve? The tortoise or the hare? Childhood story time.
I know. I want to say the hare because I like speed, but it is the tortoise. It is the tortoise every single time. And the thing is, the tortoise actually moves pretty fast in this situation. Like, just because you see somebody put out something crazy on a development project, 5x ROI, 35% IRR, like they can say whatever they want. But the fact is that there's 20 steps to get there, and the chance of them ever getting there is really, really slim.
You want to know how many steps we have on our boring properties, Steve?
How many?
3 steps. Go in, raise rents. Step number 1, raise rents. Step number 2, make sure the building performs for a while at that level. Step number 3, resell the property. It's so simple, but it's boring. And sometimes people get distracted and they want the fancy buttons and all. No. Like, keep it super simple scales.
I mean,
sorry, go ahead.
It's the same thing Warren Buffett would say. Like, it doesn't need to be fancy. It doesn't need to have 800 steps. It just needs to work. Right now, we have done this over and over. We picked Lexington and Louisville, Kentucky for great reasons, because rents are such a low percentage of people's incomes. It's a great place with stable job growth, stable population growth. No one's going anywhere. We picked great buildings that were under rented because the landlords were older. We found the markets off. We found the deals off market. They weren't through a broker. Those are the deals that we found. They have performed time and time again. If you want to hear about our latest deals, you can go to homeinvest.com. It is linked down below in the show notes. And if you're watching this on YouTube, it is in the description. You can jump on a call with myself or Nate. We're happy to walk you through. Right now, we have an LOI out on a new property that is right down the street from the two that we already own there. So we have a management team in place. We have boots on the ground, and we're going to knock it out of the park. 1.8x multiple is what we're aiming for, up to a 16% IRR. Nate, did I miss anything in there?
You nailed it, man. You got it.
All right. Awesome, guys. So we covered why you should not be doing development right now. Trust us, when the time comes, we will be right here telling you, like, hey, maybe now is the right time to be looking at development deals. But right now, stick to what you know is going to get you a solid return on your investment in this current economy. Be a great steward. That's what we're all about here at Purpose Driven Passive Profits. Nate, anything before we jump off?
No, sir. No, sir. Well, I would say continue to look at the multifamily. I'll keep preaching it. Doesn't even have to be here, but just look at multifamily as part of your portfolio, because it's the play right now during a recession.
Awesome. If you want to know what cities to invest in, we actually covered that in the previous episode, why you should not invest in Miami and what you should be looking for in cities. So whether you invest with us in our deals or another person out there, we want you to be armed with the information. That's what we're all about giving you, so that you can be great stewards. Till next time, pay attention to what you're investing in, be a great steward of your money, and we'll see you soon on Purpose Driven Passive Profits. Thanks so much for listening to our show today. Here's Nate with our latest offering.
Oh, so I'm excited to announce this. We've got a 78-unit building, multifamily property. It's 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below.